Hello, everybody. We're going to get started today on today's presentation. So just want to welcome everybody and thank you for joining us today for our lunch presentation on sales tax refund opportunities for manufacturers. Today, our SALT team will discuss the various sales and use tax exemptions for manufacturers in New York State, how to take advantage of these exemptions when making purchases, and ways to recover potential sales tax overpayments directly from the state. So I'm sure nobody wants overpayments and everybody wants their money. So we'll talk about that. I'm Carolyn Powell. I'm the development director here at Tronconi Seguera and Associates. I'll be your host again today. Quick housekeeping, couple things for you. We do have the toolbar to the right of the screen with a copy of today's handout and bios of our experts. Also too in there is our questions area, so you can pop in questions throughout the presentation and we'll get those answered for you. Let me know when you have that aha moment, that one takeaway that you're gonna work on or look into after the presentation. And also let me know if this is your first state and local tax webinar. We've done a couple of these and I know I have a lot of repeat guests, so let me know if you're new. At the end of the webinar, you'll be immediately sent a survey to complete and let us know how it was. If you want to set up a time to talk with Tom or Jared directly, if you can do that. And then this afternoon, I will send a copy of the presentation and a link to the recorded session. So if you want to go back and listen to it again or share it with a colleague, I will be sending those this afternoon. So without further ado, we're going to get started today. Again, Tronconi Seguera and Associates, we're a certified public accounting firm and business consulting. And most of you know our experts, but Tom Mazurek, he is a CPA with over 20 years experience in public accounting. He has a broad range of industry experience, manufacturing, food, financial services, software, electronic commerce, and so much more. Something I'm going to add today, we're going to do a fun fact. So one thing that a lot of people don't know about Tom is he does Christmas videos for his family. So I think it's kind of last minute done, but he takes all the year and makes a nice video and shares it with his family at Christmas time. So it's kind of fun about him. Jared is with us also today. Again, he has over 20 years experience in the industry, both in public accounting and in the private sector. He was a former employee of the New York State Department of Tax and Finance and broad range of industry experience, also a lot in the food industry, government, and IT. Fun fact on Jared today is he is a volunteer firefighter in the Rochester area. So I am gonna, before we get started today and I turn it over to Tom, I'm gonna do a quick poll just to kind of get to know the audience a little bit more and they can direct the conversation. So our first question this morning is, do you currently pay sales tax on your utility invoices? Yes, no, and I have no idea are your options. So I'll just give everybody a quick minute. Looks like we're about 50-50 on the yeses and nos. I don't know if you guys are surprised by these percentages coming up and the split that we're gonna see. All right, I'm gonna close it out in 3, 2, 1, and wow, we are a third, and a third. So
seems about right.
Than what you guys were expecting. So I guess nobody is left out on what they're doing or not doing. And then just one more before we get started today. Our second one is, how do you file your sales tax certificates? Options are digitally printed and filed in email. What is a resale certificate? And I don't collect or keep them. So
Hopefully we don't have a lot of the last two.
Hopefully not, but I'm sure we'll have some. I know we've talked about resale certificates a lot over many of our presentations, so give everybody just a minute. Looks like about half the group is digital, so I'm gonna close this out in 3, 2, 1. I'll just share it with the group real quick. Most are digitally keeping it. Some are like me, the old-fashioned print and file. Some have it in email and some aren't doing it. So gives you a little bit idea of our audience and who we're talking with today. So I am going to turn it over to Tom to get us started. Again, pop your questions in the question box and we'll get them answered for you.
Thanks, Carolyn. Good afternoon, everybody, and thank you for joining us for this webinar. Hopefully you find it informative and learn a few things about what's exempt and what's not if you're a manufacturer. And then Jared and I are going to discuss some ways that you can recover those overpayments if you have any from New York State. So our topics today, generally just a quick overview on the production exemption and what actually the production process entails. And we're going to specify this obviously to New York State today, just that's where the majority of the people on this webinar are based. We're going to talk about purchases by manufacturers, what different types of purchases from machinery and equipment, parts, tools, supplies, whatever are taxable and exempt. Then we'll obviously talk about the refund review process and what you can do to, review your purchases and then maybe identify some potential overpayments to file refund claims for. And then hopefully, if you have some questions, please feel free to, send them in, and, Jared and I are going to try to keep some time here at the end to answer them the best that we can. So just to get started, like I did say, we are going to focus our presentation today on New York. But for those who may have operations or facilities doing manufacturing in other states, just wanted to flash this chart up from the Tax Foundation. It's a few years old, and it was probably the best map I could find, so I wanted to take a quick look at it. And just, you can see from the map that the majority of states that impose sales tax do offer exemptions on manufacturing, machinery, and equipment. Out there, the states in orange that tax it, there's always some kind of gray area with sales tax. And, just noting here that Alabama and Mississippi, while they're considered taxable, they do offer a reduced rate for machinery and equipment used in industrial processing or manufacturing. Kentucky and North Dakota both are taxable unless you're purchasing machinery and equipment for maybe would be a new plant or some type of physical or economic expansion of an existing facility. So there are some exemptions in those states. New Mexico, this, like I said, this map's a little old. New Mexico does allow some deductions for their gross receipts tax, which is akin to their sales tax there. If you provide one of their non-taxable transaction certificates or NTTCs. New Mexico is always a very complex state when it comes to this. Then the other states on here, including the District of Columbia, Hawaii, Nevada, South Dakota, don't offer any exemptions for manufacturing. So very few states that offer or nothing in that sense. So we get started here and talk about the production exemption in New York State. And really the key words here are, you're producing tangible personal property, which includes gas, electricity, refrigeration, any type of product essentially for sale. It has to be something that's going to be sold. We've had some interesting discussions over the years with different manufacturers who think they're manufacturers and qualify for the production exemption. But in a lot of cases, maybe you're producing asphalt or concrete, but you're not producing that for sale. You're using it yourself, when you're building a road or whatnot like that. So had some difficult conversations with people over the years. So remember, if you're producing a product for sale, you would qualify for the production exemption. And what is it in New York State? It's a very broad, generous exemption. I know it's hard to believe to put the words broad and generous together with New York State. But for sales tax purposes, I would say, Jared, it's probably one of the most generous exemptions and broad exemptions out there. You know, in machinery, equipment, parts, tools, supplies, utilities, which we'll talk about, fuel that are used or consumed in the production process. And you say, okay, production process, you know, what is that? And we're going to talk about that here in a second. But the key to know here is that anything that's before or after what New York would consider the production process will not qualify for this exemption. So your office supplies, furniture, fixtures, warehousing, anything like that may not be exempt from New York sales tax, even though you're a manufacturer. So on the next slide, you know, what does New York consider production? You know, we have manufacturing, we have processing, assembling, which are really the three main, you know, processes we're going to talk about today. You know, generating, refining, mining, extracting, those are more specified industries, and those exemptions really only apply to, you know, your big utility producers and mining operations, which are kind of few and far between. Just generally speaking, manufacturing really results in the creation of a product that is substantially different in form, character, composition, and usefulness from its components. So I think it's a pretty basic definition, and well understood what that is. Processing really just results in the change, nature, shape, or form of materials. So if you're dyeing bolts of clothing, that's considering a processing, you know, activity. If you're crushing rocks and making them into smaller sizes than you know they originally were, that's a processing activity. And then assembling, you know, it's kind of adjunct to a manufacturing operation. You know, you're producing goods by fitting various pieces together to complete a product. Maybe it's more of a manual type operation. It's not something that's really maybe a heavy machinery or equipment dependent, but maybe you're using tools and more people just to assemble products. So very broad definition of what's considered production in New York State. So the key with that then is knowing for the exemption, where does manufacturing begin and end? It's like we said earlier, anything before or after the production process is not eligible for the exemption. So on our next slide, we look at where does production begin? And really, generally speaking, for most of these operations, production will begin with the activities of, you know, receiving, unloading, and storing the raw materials. So as long as those raw materials are not weighed, inspected, measured, tested, or inventoried before they hit the production line. So, you know, if you have a truck backing up to your loading dock, you're unloading raw materials, you know, you can count cases, count product to make sure they agree with the, you know, shipping manifests and stuff like that. That wouldn't taint the exemption. But if you're taking those materials, you're putting them right into storage or right into production, then right at the door there, right at the dock is where production starts. If you are, you know, testing, maybe you're doing quality testing on a chemical, or you're, you know, weighing it to make sure it's the right weight of a product or something like that, then production's not got to start until you place those raw materials into storage. So that early testing part of it would be considered a taxable operation. So, you know, you have to really consider that, especially some industries out there where, you know, a lot of the key components, maybe it's a chemical, maybe it's a specific type of product, needs to be tested and evaluated. That equipment used to do that may not be exempt from sales tax in New York then. So then on the back end, where does production end? And typically speaking, it's when the product is complete, it's packaged, and it's ready to enter the stream of commerce. So any type of, you know, labeling the cans, putting them into, labeling the product or box, or boxing them, palletizing them if you're selling it by a pallet load, all that would be considered the production operation. Any activities after that, packaging, transporting the completed product from the production line for storage or for shipment, that's going to be post-production. And that, warehousing, any shipping like that is going to be considered after the production process and taxable. And we're going to talk about how that affects certain pieces of equipment and materials as we go along here in our presentation. So at this point, I want to turn it over to Jared, as he's going to start talking about some purchases by manufacturers that qualify for the production exemption.
Thanks, Tom, and good afternoon, everyone. So we're going to take a deeper dive here and talk about how you qualify a purchase and then what types of purchases fall under that exemption. So in order to qualify a production purchase, you have to follow a two-pronged test. And that test is you have to determine whether the purchase is used directly and predominantly in the production process. So if you can qualify the purchase, certain things like machinery and equipment, parts, tools, and supplies will be eligible. So let's talk about first, what does directly mean? So I'll give some examples here in a minute. We'll kind of work down the slide. So in order to determine if the purchase is used directly, if you look at the first bullet, it says act upon or affect a change in material. So think of it this way: you go to a scrapyard, or like if you think of a glass manufacturer, the scrapyard, they might use like a crusher that's on an excavator to process scrap metal. That would be used because it affects a change in the material. So that would be directly used in manufacturing. Something that crushes, call it like a glass manufacturer, call it generally as something, it's like a byproduct of the process. They can actually crush that and reuse it, and it gets reintroduced into the process. So again, that's something that changes the material. The next one is have an active causal relationship on the process. So think of like a baker, they're taking raw ingredients and they're producing a finished product for sale, whether it's a loaf of bread or, some muffins they use in oven, right? So that maybe not touches the product per se, but you put the raw ingredients into the oven, it absolutely has an active causal relationship on the process using that oven. So that's a good example of that. Be used in handling, storing, or conveyance of materials. Probably the best way to look at this, or try to understand what that means, is think of racking that might be placed throughout the production line. And there's certain products you're working, you got to put them in the staging area, while you're waiting for other events to take place. Is all of that racking would qualify for the manufacturing exemption. And then on top of that, in between those racks and different storage points throughout the process, you're gonna have conveyors that move the product. And those would, be something that would be handling or storing the product. And then last, it's placed in the product in the package and it will enter the stream of commerce. So this is really, you're getting closer to the end of the production process and we're starting to talk about packaging. And a good example of that is, a machine that's used to do blister packs, or another way to look at it is, like Tom mentioned earlier, you have a palletizer system. This is a New Jersey example, but it's relatable for New York. I ran into a situation where a company might be producing an item that they sell in different quantities. Like we're entering Halloween season. Sometimes you can get peanut butter cups separate. Sometimes you can get them in a pack with Goodyear bars. So that equipment that's used to do that different type of packaging, certainly has a direct relationship to the process. So that's the first prong. The second prong is predominance. What that means is that the property or the purchase has to be used more than 50% of the time in the production process. A good example of this is if you go to like a grocery store that has a deli counter or a meat counter where they actually process meat for customers, is that they obviously have to keep that product cold. Instead, they store it in a cooler. Now, if they store it in a cooler with finished product, you'll have to determine how often you're using that cooler to store raw meat versus finished product. So that's a good example of a situation where you've got to, try to figure out how to allocate its use and then determine whether you've met the 50% threshold. So realize this, if you do an allocation and it's only 50%, it doesn't qualify. It has to be greater than 50%. So where we mentioned over 50%, that's important. So it's 51 or more. So let's jump into some different types of purchases. So first one, we have raw materials. So this could be anything from, supplies, the chemicals, the catalysts. It could be components you buy from other manufacturers that you use to incorporate into your product. The best way to avoid paying tax on these purchases is to issue a resale certificate. Now, sometimes, businesses get busy and they forget to take care of the administrative part of the purchase. They end up paying sales tax, and certainly we'll talk in a minute about how you can recover those taxes. But upfront, that's the best way to avoid paying the tax. Next type of purchase is machinery and equipment, which is probably one of the largest purchases that you'll make as a manufacturer. We just mentioned, and one of the greatest challenges is to try to determine, if the equipment is predominantly used. Now, it's great when it's 100% exempt, like it's used solely for manufacturing, like a conveyor to move product would generally be 100% exempt. You could have an oven that's baking product. You could have a mixer that's mixing product. Those are good examples of 100%. We'll talk in a little bit about material handling later on. About that's probably a pretty common purchase that is mixed use, and you have to an allocation method to determine its exemption. And then if you ever get into that situation with machinery and equipment, number one, there's a certificate that you can provide to your suppliers. It's ST-121. Again, it's the best way to avoid the tax, but certainly if you don't get that in time and your vendor charges you sales tax, we'll talk about it, how you recover those taxes later on in the presentation. And then one good example or something to think about is things that aren't commonly or thought of as machinery equipment that may qualify or get overlooked is sometimes generators that are used to supply direct power. For like the production, like say the power goes out of the facility and you need backup power to keep the process going. That could be a purchase that sometimes is overlooked. It's thought of more as like building power, which isn't commonly thought of, or is considered exempt. So there's a lot of different things that sometimes we come across that we find to be exempt that are looked at as not necessarily directly and predominantly used in production. So we talk about equipment. The next purchase would be labor. Generally, we see charges for installing, maintaining, servicing, repairing exempt production equipment. These charges as well are exempt. And so you'll see we talk a little bit about what the difference is between installing and maintaining or servicing equipment. Just a couple of examples to talk about is in New York, generally cleaning services are subject to tax. One of the common mistakes we see is that because cleaning is taxable, manufacturers who are required to clean or maintain their equipment, pretty common in the food industry. You think of like a soup manufacturer or someone's baking products. Obviously, they have to clean their equipment between different batches, and obviously for them, if they use a service or if they use chemicals to do it themselves, those are things that sometimes can qualify for the exemption and certainly can lead to some significant recovery. So this is something to keep in mind, but generally labor charges are as well are exempt. And that usually follows once you determine if the equipment is exempt, then the labor charges are treated the same. The next purchase, material handling equipment. So this is what I mentioned before, it gets into mixed use. There's a couple things you could consider here is you see forklifts that are used at the beginning and the end of the production process, pretty common to move product, whether it's raw materials or finished goods. What we see oftentimes is for smaller manufacturers is that forklift or two may be shared between those two departments. And if they are shared, then you have to have a method to determine how much of it is being used in shipping and how much is being used in raw material. And then it falls back to the second prong of the test. Is it used predominantly in manufacturing? Now, if 52% of the time it's used to move raw materials, it's going to qualify for exemption. But if it's only 47%, that would be subject to tax. So sometimes we see some manufacturers that are a little bit larger. One of the things they'll consider doing is actually isolating the equipment to certain areas of the business or the production line. So that way you don't have to keep track of, the use of a single piece of equipment and bear that administrative burden. Another example of that would be is I've seen, dump trucks for like gravel pits and those types of operations, whether if they're used on the pit versus over the road, there might be an opportunity for some recoveries or a potential exemption. So next area we'd like to talk a little bit about is parts. So obviously if equipment and the labor to install that equipment is exempt, sometimes there's an exemption is extended to the parts. Well, in case of New York, it is. So any parts that are attached to the machinery, those as well will qualify, assuming that the machinery has already been determined to be exempt as part of the production process. Tools, those as well are used in production. And one of the things to point out here is, you look at the bottom of the slide, we talked a little bit about, what's production, what's, like general maintenance. This is an area where sometimes we see manufacturers claiming an exemption for equipment that's used to perform general maintenance. And for example, we've seen where, production processes are quite large. Machines stand, 10, 15, 20 feet tall, where you might need a lift to maintain the equipment. Now, a lift to maintain the equipment would be subject to tax and doesn't qualify for the exemption. But then on the contrary, you could have a lift similar lift that's used to move and transport product from two locations in the plant, and that would qualify for the exemption. So just a couple things to be aware of, but in general, tools, could be a number of different things. It could be, someone could have screwdrivers and wrenches that are used to fix machinery. That's all considered administrative, and those would be subject to tax as well. But then on the other hand, you're going to have, you could have hand tools that are the employees using to move product down a conveyor. Maybe it gets stuck in an area and you got to use a poker, or that's a technical term. But something along those lines, right? That would be considered, direct and used in the process. So now that we touched on tools, let's talk a little bit about supplies. Supplies is really a broad range of different types of things. It could be anything from oil for a machine, grease to lubricate a component, sandpaper that's, maybe consumed in the process to, take, some type of debris or, maybe some slack off a product, solvents and thinners. And then Tom's going to touch here in a second. We want to just talk about a couple of unique things that we've seen in supplies that may qualify. The first thing I've seen was I used to work at a food manufacturer, and they would do batch after batch of soups. And in this process, they had clean in place equipment where the soaps would actually enter the production line in between the batches. And we're able to qualify those cleaning supplies because it was a continuous manufacturing process. So that's something kind of unique. I'm going to turn it to Tom real quick, and Tom's going to talk about what he saw at one of his clients.
Yeah, I'll never forget, we had a client that made a lot of mentholated type products and ointments and gels for consumer use, and very greasy type product that they produced in large kettles and whatnot. And we saw when we were doing a refund review, they were purchasing Dawn dish detergent, lots of Dawn dish detergent. This wasn't for the kitchen or employee break room. So we asked about it and they were like, oh no, we use it in production. You know, that's the best thing we find that cleans the kettles because they're so greasy. So yeah, I remember having to convince the auditor or the refund unit or whoever it was, like, why this is exempt from sales tax. So never forget that one. That one always sticks with me.
Yeah, and I think we often find there's some unique things. Everyone's process is different.
Mm-hmm.
And sometimes, something like that, the cost of it can add up and then you get substantially overpaid.
Oh, definitely.
Yeah. All right, so let's spend a couple minutes here on motor fuel, diesel motor fuels. Now, with these purchases, there's a, somewhat of a unique process on how you claim credits or refund. You'll see at the bottom of the slide, you mentioned that you have to file a refund claim for Form FT 500. And then, some types of purchases that might qualify, think of it this way. Recently, I was in New Jersey and I saw, again, this could apply in New York. I saw a process where they were using a payloader to move raw material from one part of the process to a conveyor, like from a standing pile to a conveyor. And that payloader would be used consuming diesel fuel. So that would be considered part of the process. That's an example. Another one would be propane for forklifts, not necessarily fuel oil or motor fuel, but in place of, like gasoline or diesel, it's pretty common to see propane inside, large manufacturing complexes. So just keep in mind, try not to issue a certificate there. If you did overpay tax, you'll want to file a FT 500. So next type of purchase, computer software. So if the software is used to run the machinery or control the machinery, it's going to qualify for exemption. Now, if you have a significant ERP system that you use to run your business administratively, now that purchase won't qualify. A couple of good examples to illustrate what would qualify is you have software to run a 3D printer or software that may control a laser cutting machine. Those are a couple of good examples of software purchases that would qualify. And then lastly, something that wouldn't is SAP or Oracle or QuickBooks would not qualify because that's used for administrative purposes.
I think a lot of people have issues with that because they see that there's inventory modules and stuff like that with ERP systems and scheduling and whatnot, but right, it's not controlling, it's not running the production process, it's adjacent, it's an administrative function. So yeah, I've talked to a lot of clients down over the years on that.
Yeah, even if there was like a minuscule amount of time that system was controlling something, you're going to get into the predominance test, and it's likely not going to qualify because it's going to be used more than 50% of the time for administration.
Yeah, that's a great point.
Yeah, so then let's touch on cartons, containers, and other packaging materials. So this could be anything from boxes to paper. Not so much these days, but paper to print instructions. You could have dry ice for keeping product cool, when it's transported from your warehouse to a customer's location. And then the list goes on. I mean, we're talking tapes, staples, really anything that's transferred to the customer, and the customer has the right to keep it, reuse it, or even destroy it, right, or throw it away. In my past experience, I saw where a former employer of mine, they would use special packaging to move pharmaceutical products to keep them secure. But it was something that, again, was transferred to the customer, and it would qualify for the resale exemption. The other couple of examples you might see is like in the deli, you go get sliced meat, plastic bags would qualify, or using different types of wrappers and twine and stuff for meat processors, which is, eligible in New York State. And then labels and text. So this, really could be a number of different things, but just some really good examples of labels and tags that would qualify. Prescription label on a bottle would be something purchased for resale. Like on contact lenses, you could have a left or right sticker that would be part of the packaging. And then quite simply, like if you think of clothing, right, that's manufactured, or, even as far as like when it makes it to a retailer, it shows you where the exemption extends to like retailers where you put a price on a piece of, or an article or piece of equipment, the price, it tells you how much you're going to pay. That gets affixed to the product and also would, qualify as a label or tag. So it's fairly broad, the exemption for labels and tags, but again, it comes down to when you think about like cartons and packaging, is it transferred to the customer? Do they have a right to do what they wish with it? So, so at this point, I'd like to turn it back over to Tom, and Tom's going to talk a little bit about safety apparel and different supplies that would qualify.
Yeah, thanks, Jared. As we're talking about other types of purchases that would qualify, if you are a manufacturer who is providing what you call safety apparel and safety supplies to your employees, and these materials are indispensable to production, it's something that the employee needs for their safety. Well, as I guess New York would put it, the more safety of the product, right? If you think about it that way, they don't necessarily care about the employee. It's just that it's something that would damage the product or whatnot. So uniforms and hair coverings, beard coverings, safety shoes and gloves and goggles, all of that would be considered something that's necessary, a safety apparel item that you could purchase free from sales tax. I know we had an issue once, Jared, with radiation badges, like the dissounder badges, and New York would not exempt on the refunds. They said it wasn't, within the production process. It was just for the employee to measure if they were exposed to radiation, but it wasn't enough of a connection to the production process to exempt those items. So found that interesting.
Yeah, what was the state's position?
It just was, it wasn't, they didn't consider it indispensable. It wasn't something that was necessary, so to speak. It wasn't, the employee couldn't taint the product if, with that bad. They can be exposed to harmful levels of radiation, but state didn't care. So another area that's often exempt is quality control. Any machinery and equipment or tools or supplies that you're purchasing to, test or QC a product while it's still on the production line. We talked about before and after production process, as long as it's still in production, you're pulling something off during the process, maybe measuring it, testing the formula, the ingredients, consistency, anything like that, while it's still in production, then that equipment or tools will qualify. And it's not necessary to do it right on the line. You can move it to a separate laboratory or whatnot, but it can't be used to test the product after it's finished and ready to enter the stream of commerce. Adjacent to that, I guess, would be what we would consider waste treatment equipment. The big issue these days, and I love New York's definition of it. They say machinery and equipment qualifies for the exemption when it's directly and predominantly used in treating, burying, or storing waste materials that are 50% or more resulting from the production process. So we're talking about burying waste materials still. It's probably not a good thing, But, this is a very broad exemption. If you're talking about dust collection filters that might be involved in the process, waste treatment equipment that's treating maybe both sanitary waste and effluent from the production process, as long as it's, 50% or more, we talk about predominantly, using to treat effluent from production, that would be exempt from tax. So the waste treatment's a very broad exemption when it comes to this for New York. Research and development, again, not, maybe necessarily consider production adjacent, but New York does provide an exemption for machinery, equipment, tools, supplies, utilities that are used in R&D in what you would consider the experimental or laboratory sense, where the ultimate goal may be advancing research in a particular field, developing a new product, developing improvements to an existing product or new uses for existing products. Different from quality control, obviously, right? You're specifically developing, researching a new use for something. And, often this gets kind of all jumbled up at a manufacturing facility. You might have an R&D lab that's also doing quality control, or it could be testing raw materials, and you could be using the same equipment, maybe the same microscope, the same centrifuge or measuring devices to test incoming materials, stuff on the line, and use for R&D. So that's where that whole directly and predominantly really comes into play. Maybe you have 3 microscopes and, on average, one of them is for testing raw materials. You have to really think about that if you're looking to take a sales tax exemption or a refund on that equipment. I find with R&D too, you look at equipment that's maybe used to create or maintain an atmosphere, certain conditions in rooms, right? And that goes for production too. If you need a certain humidity or a certain temperature, that equipment that's being used to create that environment, is likely going to be exempt from sales tax. I think we just saw that on a tour we all took, recently of a local plant where they had a humidified, controlled, pressurized room for production. So that equipment doing that, and even the utilities that are going into the equipment creating that room would be exempt from sales tax.
Yeah, another good example, Tom, is like a bakery, like where does the clean room stop?
Yeah.
Because you gotta have certain atmospheric conditions that have the right, ideal baking conditions, and that's one.
Mm-hmm.
That would be almost the entire facility.
Yeah.
It's quite crazy.
It can get, and you really have to prove something like that to New York. They don't go on that very easily.
Yeah, they'll take it easy.
Yeah. And then the one thing to note about R&D though, that Jared talked about how labor for installation, repairs, maintenance is exempt for production equipment. It's not though for R&D equipment. So just something to note, if you have contracts or somebody coming in to repair, they may be charging you sales tax on that stuff. So moving on, so a couple more items we want to talk about. One of the biggest issues that we always see, and obviously based on our poll at the beginning, is utilities used in production. Some people were saying that, I think we had a third, and a third, right? Paying tax, not paying tax. New York doesn't really make it easy in documenting this, and they provided an exemption. It's not as broad as some other states because it's directly and exclusively, which we'll talk about, whether it's electricity, refrigeration, natural gas being used in production is exempt, but it's, something that is a little more technical. And New York doesn't make it easy on a manufacturer because some states will allow you to maybe just put a percentage of use, maybe, if you 75% of your facility is production equipment that your energy is going to, maybe you only pay 25% on your utility invoice. I think Pennsylvania does that. In New York State, you're either paying 100% of tax or you're paying no tax. So if you pay 100% of tax on your utility bill, and 75% of it is for production equipment, then you may have to file a refund claim. Or if you pay no tax, you still have to accrue some use tax on your return and remit that to the state to cover your non-production energy use for your offices, for your shipping and receiving warehouse areas. So it gets very complicated when it comes to utilities. And the exemption basically, we talk about directly. Obviously, directly means it has to have some type of impact on the production process. It's operating exempt machinery and equipment, creating those conditions necessary for production, like we said, or performing an actual part of the production process. So we also talked about the difference between predominance and exclusivity. Exclusive means that this electricity, this gas is used 100% for production. So you have, predominant, I think the state like Texas and maybe Maryland too say, if you're over 50% exempt production use for your utilities, whole invoice is exempt. New York says, no, it has to be specifically for that equipment. So that's where we get into an exclusive threshold on New York bills. And, it's not easy to determine this exemption, right? You may have one meter in your plant where all your electricity is coming through. Well, some of that, like we said, is maybe it's going to the office, it's going to the employee break room, it's going to the warehouse, and then, there's a good bulk of it that's going toward your production equipment probably. So you need to show New York State how you're allocating this in order to receive a refund, how you're allocating it. You need to do what we call a utility study. Some type of survey or formula to show how you're arriving at this exempt use. And it's very technical. Here at Tronconi Segura, we're not engineers, we're not lawyers, we're accountants. So when we help our clients with stuff like this, we bring in an engineer, mechanical engineers and electrical engineers who can get to these numbers for us. We'll tell them what's exempt, and then they figure out the usage of what use of those utilities and get to a pretty good number. And Jared, what would you say? I mean, with manufacturers, what what percentage do you think of a manufacturer as being exempt for utility use?
I mean, it's usually probably 75 to 90%.
Yeah. Yeah, it's typically what I think we see. You run into a lot of people who think, 90%, this and that, 100, no. So you got to think about, there's a lot of stuff that's not exempt when you look at that exclusivity. I guess lighting.
Lighting is probably the biggest one.
Yeah. I guess New York thinks you can manufacture in the dark. You don't need lighting that's not exempt for production.
Stuff for creature comfort, right?
Yeah, exactly. They could care less if it's 90 degrees in there and the employees are warm.
They can be miserable and, still producing product.
Yep. So definitely utilities are something that really need to be looked at closely. And, I find a lot of companies will tell me, oh no, we have a survey that they did 20 years ago on the back of a napkin, and that's the formula they've been using, which, there's a good shot that's not going to stand up to an audit. I'm sure, Jared, in your past life, that was something you guys would look at.
Yeah, and often we would accept if the studies were done ahead of time.
Mm-hmm.
So being proactive, this is an area you want to be proactive because it limits the amount of questions the auditor might ask. Because if nothing's done, then they're going to make the assumption. Let's say you give a certificate to your supplier, you don't pay any tax.
The supplier doesn't care. They got the certificate.
And it's the state's, now the state has control. They're going to decide what you're paying.
Mm-hmm.
So it's always best to be proactive and try to get it done ahead of time.
So I think that covers a lot of the purchases we wanted to talk about. I think we're gonna spend the last few minutes here before hopefully doing some questions and answers about refund reviews. Typically we hear, like we see with a lot of our clients that who are manufacturers, paying the correct amount of sales and use tax is a very common problem they have. I mean, you may not have a ton of people who are looking at invoices, you have to be sending out exemption certificates correctly or whatnot. But, if you do have this problem, there is a number of ways you can correct it, right? Conduct an internal refund review, maybe annually or on a quarterly basis, or if you have issues with questions about invoices that are coming in, and we'll talk about what a refund review looks like. You can engage or hire an experienced third party, to review your purchases for you, and identify any potential overpayments that might be out there, file a refund claim. And then I think a lot of people maybe take the tack that, well, I'm going to be audited someday. I'm going to wait for the auditor to come out and, he's going to tell me I'm overpaying tax, right, Jared? That's what you were doing when you were out there?
Yeah, the guys that are coming in to look for revenue are not the ones that are going to find the places where you've overpaid. Because a lot of times people think the state's there to do an audit, but also keep in mind, they're there to make sure that the state is receiving all of the collections, all of these self-assessments that should be made by the various businesses throughout the state. So the state is probably the last people you want, to determine how much your refund is. So I would say probably option 1 or 2 is better, right?
Yep.
Do it yourself or hire someone to help you.
Yeah,
and advocate for you.
Yeah, it's not their job, right? They're not looking to give you money back.
It's really your employees or a consultant are the folks that are going to advocate on your behalf.
So Jared, tell me, what are some of the benefits of conducting one of these refund reviews?
Yeah, so I mean, obviously, you get to recover all the tax you paid there. I mean, that's cash flow for your business, which is great. You're gonna, look and you can say, okay, these are some of the issues I have in the compliance process, and you can make changes to smooth that out. And then that way, for the future, it's, you can keep that cash, you can do things for your business to expand or grow it. And then training your staff. So if you go through one of these reviews, obviously, you're good at running your businesses, we're good at helping people pay the appropriate taxes. And, we kind of stay in each other's lanes but we're there to help each other. And when you go through something like this, it's an opportunity to, one, drive down your costs,
mm-hmm.
and then help educate your folks on how can you make these self-assessments without having to invest a ton of time and energy to pay the appropriate tax. So.
Yeah, I think all very valuable. And, if you're doing the refund review, if you're identifying where you're making these mistakes, it's, correct them, provide that supplier the exemption certificate then going forward,
Yeah, it takes way more time and resources to get money back than it is to pay the appropriate amount upfront. So
yep.
It's worth the effort.
For sure.
And Tom, why don't you tell us how you typically do one of these?
Oh God, I've been doing these for over 25 years. When I first started my career as an intern, the first thing I worked on was a refund claim project for a dental products equipment manufacturer. So I think, I put number 1 here is learn about the production process. That's the first step. Whether, you decide to hire someone to look at this or internally, you got to understand, like we talked about, where does production begin and where does production end? What is that equipment doing in the middle there that's actually producing tangible personal property for sale? You got to get out on that floor, take a tour, understand the flow of the production activities so you can kind of define that beginning and end point so you know what equipment's exempt, right? I think that's huge, key necessity before you do any of this, because, at some point too, you may have an auditor, if you're being audited, they want to see the production process. You need to understand and be able to explain this to them or have somebody in the plant explain this to them.
Yeah, one of the things, like going early in these tours before you take the auditor, if you have to, is you can talk with the plant folks who are, they're the nicest folks, but they often share too much information.
Yes, they like to talk about their plant and their equipment.
And I'm not saying withhold information, but I'm just saying sometimes, information is interpreted in different ways.
Yeah.
So,
Yeah.
so depending on how you say it.
Yeah, we did a tour once of a R&D facility. I mean, there was nothing in my mind that said any of this stuff was taxable. They were clearly using all of this equipment to develop new products. And I don't know what the guy who was giving the tour said to the auditor, but we got done with the tour, and my colleague and I said to the auditor, so we're good, right? And he's like, oh no, this is all taxable. And we're like, what? He cited some old New York State case, and we're like, what? But we straightened it all out, thankfully. But, just real quick, we're running out of time, and I'll save a few minutes for some questions. So get those in if you have any. Once you understand the production process, you got to gather the necessary documents, right? You got to get your purchase invoices for whatever period. Typically, you want to go back 3 years, statute of limitations if you haven't done this before. Look at those invoices. You want to get your sales and use tax returns to see if there was any use tax you remitted. Look at your chart of accounts, see where, items are going. If you're maybe a larger company, you got to get some data, maybe your accounts payable distribution, your GL, just to see all the charges that are going to specific production type accounts. You got to review those invoices. You're going to look at what's being purchased, the parts, the tools, the equipment. Purchase orders sometimes have a lot of good information on them, as to what something is being used for. You got to maybe ask questions of different folks in the plant to get an idea of how something's used. And then you take, those invoices, you prepare a really nice schedule, detailed schedule with all the information from the invoice on it. The applicable regulations or tax law section, and you send that to New York State. You file a refund claim, and Jared's going to talk about how we do that, or how you can do that. And then most of the time, you're going to get some correspondence back from the state, from the person at the refund unit, typically saying, hey, I got your claim, I'm going to look at it, or you provided everything, you didn't provide everything. They're going to tell you what they need. It might ask you some questions, might have a call with them to talk about it, do some back and forth. And then hopefully at the end of that process, you're going to get your refund check. Always want to reconcile that amount to, what you filed, see what was denied and why it was denied, if there was anything that the state wouldn't grant you a refund for. And, maybe it's a big issue, maybe it's a small issue, but you want to decide, this is something I want to appeal. Like, do I want to go back and, take additional action to, recover the tax on these purchases? And then I think the most important thing at the end of all this is you want to make changes. You've gotten some refunds in on stuff. Well, obviously it's not taxable. So don't continue to pay tax and be doing this process going forward, right? You want to provide that ST-121 exemption certificate to your vendor and, move on from there. One less thing you need to worry about. Jared, real quick, you want to talk about how, just filing refund claims. How do I do this?
Yeah, so whether it's yourself or, you partner with, a team of experts to help you file a refund claim. In New York, there's a couple ways you can do it. You can file a Form EU11 as a separate refund claim, and it also can be attached to one of your return filings. Now, if you're a business that collects a lot of sales tax, there's good opportunity and a possibility of filing an EU11 and taking a deduction on your return. But if you sell a lot to retailers, so you got a sale for resale, and you're not collecting the tax, you're going to end up having to file a Form EU11. Now, one of the keys is remember that time is limited. So if you paid the tax you only have so much time before that you can file a refund claim. So let's say 2 years from now, you paid $1 million in sales tax and you shouldn't have. You only have, within 3 years from the date it was due, or 2 years from the date you paid it. So if you're, 4 years from now, that means you're out of luck. You can't get the money back. So it's really time sensitive. You gotta pay attention to that. So when you're filing a refund claim, some of the things that are really important, as Tom talked about, is just making sure all that documentation, whether it's hard copy or digital form, is attached to the claim. Now, when the claim is filled out, certainly, it's very important to make sure the boxes are filled out correctly. You don't want to get tripped up on a formality, like if someone says, okay, you forgot to sign it, so we're going to deny your refund claim. It sounds crazy, but it happens.
Mm-hmm.
So these are things to pay attention to. And then make sure that it's provided timely. So years ago, we used to send it by mail and we'd have to certify it. Now the state has provided a website where you can submit the claim electronically, which is great. But the thing to remember is things still get lost in the outer space. And like a certified, you want to make sure you print confirmations and those types of things, because it's really important to have should the auditor or the reviewer question it. So those are probably some of the most important things to keep in mind when you're working on, filing a refund claim. So I think, unless Tom, has anything you want to add on refund claims, I think that covers.
No, I think that's it. The state, they get to it pretty quick, right? I'd say within a couple months, typically you get a response from somebody if you're filing it, with the state compared to doing it during as part of an audit. When you're doing it as part of an audit, it's kind of different process. But they usually get to it pretty quick and they're pretty responsive. And, if they tell you 30 days, to respond or provide something, it's 30 days. If you're getting toward the end of that time, definitely call and ask for an extension. They typically will grant it. They'll give you an extra week or two, but, don't ignore the correspondence.
Yeah, in the States, the desk auditors have been pretty reasonable of late.
Yeah.
I know there's always concern, hey, I file a refund claim, I'm gonna get audited.
I've never in my career seen it.
And I think one of our audience members could speak to this, is we filed and has experience that we filed a $1.5 million claim for a client. And then 6 weeks later, after a couple of emails back and forth, they cut the check, which, kudos to us for putting together. That's what we talked about, like, how do you prepare for a refund claim? We must have, dotted all our I's and crossed our T's, but but it happens. And then, we have some where I had a client, we filed multiple amended returns, but we did it in 2 separate packages. The first auditor looked at it differently than the second auditor. So sometimes you just never know what you're up against.
Yep.
But the one thing we've learned, I think, working, and putting these together is that being thorough, asking the right questions, having the documentation gets us to a really good place and generally a good outcome. So.
Yeah, there's never enough documentation to provide.
Well, thank you guys. If anybody has any questions, throw them in the question box. Like I said, you'll get a survey at the end of this webinar when I close it out. If you need anything or want to set a meeting with Tom or Jared, and just if this webinar was helpful for you. And then this afternoon, I will send a copy of the presentation and a link to the recorded session to listen to later. So we thank you for joining us today and staying on a couple minutes after 1 o'clock. And have a great day, everybody. Thank you.